Welcome to The Explainer. Today, we're breaking down a fascinating concept that completely redefines how we interact with the markets. Look, if you've ever found yourself totally exhausted after a long trading session, just clicking buy and sell in an emotional frenzy, then this is absolutely for you. We're going to deconstruct the mechanics of the one trade per day strategy. It's a shockingly simple approach to completely transforming your market consistency. We'll be pulling directly from top trading frameworks to show you exactly how limiting your action can actually maximize your results.
So, let's dive right in by asking a pretty tough question, one that immediately challenges the typical day trader's ego and habits. Could you realistically limit yourself to just one trade per day? For a lot of beginners, the immediate answer is a hard no. There's this persistent myth out there that more screen time and more clicking automatically equals more profit. But as we're going to see, the absolute most successful approaches often rely on extreme restraint. We really have to contrast the frantic, emotional reality of manual overtrading against the cold, calculated precision of just waiting for perfect setups. Overtrading is usually born out of anxiety, right? You're jumping into a wildly volatile Bitcoin chart hoping to catch a random spike just because a 1-minute candle flashed green. High-quality setups, on the other hand, they require you to act as a sniper, not a machine gunner. Imagine just patiently waiting for gold to tap a major daily support level and then executing one precise long position. You're literally waiting for the market to prove its direction to you before you commit a single dollar of your capital.
To really hammer home why we shouldn't overtrade, I want you to consider this number, 6.8. This specific metric represents the daily average of algorithmic systems. Data shows an automated system placing over 1,000 trades in a few months, averaging 6.8 trades every single day, 24 hours a day. Honestly, humans simply shouldn't try to compete with that kind of machine volume. Algorithms don't feel fear, they don't revenge trade, and they definitely don't need coffee breaks. When a manual trader tries to mimic that high-frequency approach, it almost always ends in a massive emotional blowout.
Which brings us to a foundational, kind of uncomfortable truth in the trading world. Prediction gets punished. Positioning wins. Most beginners wipe out their accounts because they're hyper-focused on guessing market direction. They think, well, gold has gone up way too much, it has to come down. Or, Bitcoin is definitely breaking out today. They're predicting. Professionals? They don't predict. They position themselves around established structure. They wait for the market to hit a specific zone, and then they react. If you're out there predicting, you're just gambling.
So what's the actual fix for the overtrading trap? It's the one trade per day strategy. It's a strict rules-based framework focused on making one high-quality trading decision daily. It shifts your entire operating model from constant action to selective patience. You aren't logging on to see if you can trade. You're logging on to see if your one specific setup has appeared. And if it hasn't, you do nothing.
Let's look at the psychological armor this gives you. Limiting yourself to a single daily decision acts as a massive behavioral safeguard against mental exhaustion. It forces your emotions to stay in check because you know, hey, I only have one bullet in the chamber for the day. You naturally dedicate way more time to researching your setup. And most importantly, it completely eliminates the dreaded revenge trade. We've all been there, that impulsive second or third trade you take immediately after a loss to try and win your money back. By minimizing your exposure to choppy conditions, you protect your mental capital just as much as your financial capital.
Section 1. Finding high-quality setups. By analyzing these core approaches, you can actually select the single daily strategy that best aligns with your own thesis. You've got momentum trading to capture quick shifts, range trading where you patiently buy support and sell resistance, breakout trading for those level breaks, and candlestick pattern trading. Whether you're trading high-liquidity assets like BTC/USD or traditional markets, you really need to pick one of these lanes for your daily setup, and crucially, every single one of these requires a strict risk management focus to avoid fakeouts and false signals.
Notice how heavily this emphasizes top-down analysis. A massive mistake traders make is zooming straight into a 1-minute or 5-minute chart and just getting completely lost in the noise. To find your one high-quality trade, you must first frame your thesis using the one-day pattern. That daily candle tells you the overarching story of the asset. Once you understand the daily narrative, only then do you drop down to the lower timeframes to hunt for your precise entry.
And this is exactly how you frame that structure. Before placing a single order, you've got to meticulously mark the previous day's high and the previous day's low. These are your core liquidity zones. If you're trading gold, for example, you wait patiently for the price to reach these extreme daily levels before making a decision. Why? Because the middle of the range is where the chop happens. It's where retail traders get trapped in the noise. Your one trade should happen at the edges of the structure, not in the messy middle.
Section 2. Step-by-step trade execution.
Okay, Here is the rules-based framework that separates professional execution from amateur gambling. Step 1. Identify the setup using box theory, drawing your structural boundaries based on those highs and lows we just talked about. Step 2, and this is the hardest for beginners, wait patiently for the confirmation shift. Seriously, don't guess, wait for the chart to prove it. Step 3, execute your one-plan trade. And Step 4, which honestly might be the most crucial of all, close your laptop. Win or lose, you are done for the day.
When you draw your box correctly around the structure, the rules are absolute. Never buy a breakout directly at resistance. That is exactly how volatile markets punish you with fakeouts. And never sell a breakdown directly into support. You absolutely must demand a confirmation entry model. This is where concepts like the one-candle setup come into play, allowing you to snipe an entry only after a specific candlestick confirms the directional shift on your lower time frame.
Section 3, Managing Risk and Psychology.
I really want this mantra to stick with you. Stop predicting and start positioning. It represents the fundamental paradigm shift required to become a consistently profitable trader. Once you accept this, the anxiety of trading really starts to fade. You no longer have to possess a crystal ball. You simply have to be an excellent manager of risk when the price enters your pre-planned zones.
Look, even the absolute cleanest one-candle snipe requires ruthless risk management to protect your account from unexpected market swings. Because you only have one trade, your fixed daily risk parameters must be set in stone. You must mandate proper stop-loss placement the second you enter the trade. You have to accept realistic risk to reward targets rather than hoping for some lottery ticket home run. Crucially, if you miss your setup, do not chase momentum out of FOMO. And finally, if your one trade hits the stop-loss, just accept it. A losing trade isn't a failure of your worth, it's simply data indicating the market didn't follow through today.
The psychological toll of overtrading is immense. Staring at a chart for 6 hours, clicking in and out of a dozen impulsive, emotional entries, it'll drain your energy and, more than likely, your account. But applying this selective confidence allows one good, structured trade on Bitcoin or gold to completely outshine hours of erratic clicking. It brings peace, it brings discipline, and ultimately, it brings sustainability to your trading routine.
We're ending this explainer with a final challenge to your discipline. I want you to think deeply about this before you sit down for your next session. Do you realistically have the patience to take just one trade, accept the outcome, whether it's a win or a loss, and physically walk away from the screens? Because mastering that single habit might just be the most profitable strategy you ever learn. Thanks for joining me on this explainer, and I'll see you in the next one.